good afternoon, or morning to everyone. Welcome to the first edition of the NAM Energy Monthly Pulse, a collaborative initiative between the National Association of Manufacturers and our NAM Energy partner, Environ. My name is Jack Ralston. I am a Strategic Partnership Specialist at the National Association of Manufacturers, and we're thrilled to welcome Ben Walker, Vice President of Market Analytics at Environ, will be providing monthly snapshots of key dynamics shaping the energy market today and what they mean for your energy buying strategy. We'll be taking questions following the briefing, so please feel free to enter them in the QA during the session. Webinar slides will also be shared 24 hours after the end of the webinar. And now, over to you, Ben.
Thank you, Jack. And thank you, everyone, for joining today. And happy St. Patrick's Day. I've got my shamrock tie on to celebrate. Excited to have these opportunities to review energy market events with you all. This is going to be a quick roundup today of really these three focus items, and then we'll jump into one or two things at the end too. I know everyone's been looking at the headlines and seeing Iran and the Strait of Hormuz has been in the headlines probably more often in the last couple of weeks than it has since the 1980s. The Strait of Hormuz is where natural gas and oil tankers have to, leaving the Persian Gulf, they have to go through that. And so this represents about 20% of our LNG, or liquefied natural gas, and 20% of oil supply globally. So with the recent US and Israel attacks on Iran, that strait has been kind of closed to traffic, and I say kind of closed. It's been closed to traffic with the exception that Iran is trying to say more publicly that it's closed to their enemies and not their allies. So 1 to 3 Indian and 1 to 3 Chinese tankers have kind of slipped through each day, off of maybe 100 tankers flowing through that. So it's not completely closed, but we are seeing significant impacts in the reduction of oil and LNG supply globally. Recently, there was the largest ever coordinated release of the oil reserves across the 20, 30 plus countries that all are a part of the International Energy Association. And so we're this is all the superlatives. This is the largest supply disruption, also the largest reserves release. What that's doing for domestic prices, the US is in a situation we're actually pretty fortunate that we are a net exporter of natural gas. And so when kind of the immediate trading days after the war, and it's roughly still true, US prices were up 5%, and Asia and Europe prices were up 50%. So for domestic natural gas pricing, this has been mostly a concern in terms of the long-term, long-run economic impacts, with the exception of New England winter. That's the one region, and we'll get into that more, but that's the one region domestically that is exposed to the natural gas changes. The US is also a net exporter of oil. However, oil is less of a kind of a fungible good, exchange one for one, than natural gas is. So oil, there's more variations in the product from heavy to light. And our refineries aren't that well equipped to use our own oil. And so we do still have to buy and sell oil on the global markets. So even though the US is a net exporter of oil, we are seeing domestic oil prices rise as well. Given the 20% reduction of oil and kind of the expected demand impact and the economic, it's called the elasticity of demand, but kind of given the economic impact of that, we expect oil prices to be anywhere from that $200 to $300 range if we do see kind of a prolonged event here. Again, the strategic release of oil was very helpful for that. On the power side, the US is fairly well insulated. So oil makes up less than 1% of our capacity and less than 1% of our total annual generation. I've plotted generation here on the bottom right. You can see that coal was the dominant fuel in 2015, and it's fallen off in the last decade. And petrol is that tiny black line, right? That's where we get oil generation. And again, we just aren't really exposed to the same kind of price shocks domestically for power, with the exception of New England. New England is the end of the pipe in terms of natural gas pipelines, And when it gets cold in the winter, which it does in that region, a lot of that gas is diverted towards heating and away from power generation. And so power generators need to replace that with liquefied natural gas or oil. And so you do see oil, hitting 40% of generation mix in some hours in the New England region, which is really, it's the Jan Feb months for that region is really the only exposure we've seen in terms of this for domestic kind of power and natural gas prices. And then the other concern that this has brought up is, what happens to the economy if this is a sustained conflict? That really could start to put the brakes on some of our growth. Uh, at the beginning stages, right? What you may remember or not, but there was a war last summer called the 12-day war, and we're already past the 12-day mark now for this event. If we could resolve it quickly, this might be kind of a blip in prices that gets resolved quickly. But the longer this goes on, the longer the kind of more impact it has, and the more of a drag it creates, which just pushes us into kind of a more challenging situation and would start to impact energy prices around the country. From a kind of even higher bird's eye view, there's been an effort over the last few years uh, led by BRICS. So that's a acronym of different countries, Brazil, Russia, India, China. It's now 10 plus countries trying to trade energy in non-US currency. So the US dollar has been the global dollar for energy trade, specifically oil, really for 50 plus years. And as those, that comes with a variety of benefits to the US. It makes our debt extremely cheap. And so as our debt grows, if we have BRICS really succeeding with alternative payment schemes, we could not only see debt grow, but the cost of servicing that debt could also grow. And so it could be kind of a double whammy there to our economy. And we're also seeing precious metals on a bit of a wild ride with some of these events. Again, the US dollar has been very, very stable, which is why it's been used. But politically, some countries are looking to extract themselves from that. And sometimes turning to metals to support some of those contracts. I mentioned earlier, Iran is trying to let some of their allies tankers through. Those are most likely denominated in yuan, the Chinese currency. China is also trying to push for a LNG contract that is denominated in their currency as well. So interesting to see how that plays out for the global economy there. To support as a proof point to what our markets did immediately afterwards. We have the pricing at Henry Hub, which is the U.S. national benchmark in Louisiana, the TTF, which is the Netherlands Tidal Transfer Facility. It's the EU benchmark, and then the JKM, the Japan Korea marker, and so that is also the Asia benchmark. And you can see in the April 2026 contract, so the future price for April 2026 gas late February, it was about 280 in the US and natural gas in Europe a little bit over 11 and in Asia a little bit under 11. The war happened March 2, 3, 4. Henry Hub, the US price didn't move that much. And overseas, we saw prices jump pretty significantly up into that $16 and $18 range. And when I updated these slides this weekend, we were still kind of in that same boat of a $3.14 price for US and 16 and change for overseas. Again, just kind of highlighting that our exports have really been very strong for our production has outpaced our exports. And so we are exporting as much gas as we can, but pricing domestically has stayed relatively stable. I'll note, throughout this series and this conversation, when I talk about natural gas, no matter where you are in the US, you do have a choice of who you choose for your natural gas supply. That's true 99% of the times. There are occasional municipal utilities where you have to be on the utility delivery rate. But in the most part, in the US, you can choose your natural gas supplier. On the power side, you have fewer options. It's about 1/3 of the states, roughly 2/3 of the population, have electricity choice. So if you're joining this, I would assume that you are looking at your procurement contracts from what can we do with our supplier? But we do help clients who have regulated utility supply as well. But most of this conversation is focused on the competitive supplier choice. So to continue the LNG conversation, this has been the largest demand driver for, sorry, the largest, I would say, demand growth driver, the largest concern for the markets for probably the last 10 years. We didn't export LNG, we didn't export gas at all before 2016, and we just have been slowly and incrementally building that up. So you can see the export capacity from 2019 at 5 BCF per day, going up to, we're currently just around 20. We produce about 100 BCF per day, roughly. And so the left axis you can read is BCF per day or percent. So roughly 5% in 2019 was our 5% of our production went out to LNG exports. Now in 2026 at 20 BCF per day, it's about 20% of our domestic production is shipping overseas. And you can see the kind of confident runway we have in terms of approved capacity that's under construction in the light blue. And then in the darker blue at the top, that's the capacity that has been approved from an energy regulatory standpoint, but it hasn't started construction and it hasn't reached critical financial investment milestones. So those projects likely will come online, but the timing of that is a little bit less certain. I mentioned the runway for growth is more certain. Here's what LNG exports have actually done. So this is the amount of gas we've actually sent out. Again, we're not quite at full capacity. We would never really expect to hit that, but we would always bounce around towards the top of that ceiling there. The one dip you see in 2020 was when the Freeport terminal, the export facilities went offline. Markets all of a sudden had a bunch of extra gas and pricing was very favorable for a few months there. I mentioned that only because Freeport had a hiccup Christmas time, early January this year, which put a little bit of concern in the markets of to see Freeport again have a problem. We saw prices down for a few days and then they kind of came back up. It's interesting to me to compare and contrast the LNG export growth, which again has a very, very high ramp. We are definitely looking at these upcoming cliffs in 27 and 29 to see some big demand increases. To compare that with power burn. So this is the largest demand for natural gas in the US. This is where we take natural gas, put it into a power plant and produce electricity. That has been the largest demand driver. It's also seen a large growth, just like LNG exports have. But the runway for power burn is a little bit less certain. The LNG exports, we've had 10 years now to look to build some of those export terminals, the pipeline capacity that supports that, and even the production to respond to that. So that one feels comfortable to the industry. But data centers really jumped onto the scene. It's close to 2 years ago now, but they've really put a lot of pressure on our power grids and our power needs. And it's less certain what the runway is or what the infrastructure growth might look like on the power side, depending on whether we can build power burn demand facilities, power plants fast enough. LNG might catch power burn. That seems a little bit crazy to say even a few years ago. But just given the pace of LNG growth, we're definitely looking at that as a pretty big risk. As we mentioned kind of on the previous slide, gas can be sold overseas at 2 to 3 multiples of what it's sold domestically. And so producers have every incentive to export gas as much as they can. There is some transport cost, which knocks $1 or so off of the price, but the incentives are there to send that gas overseas as much as we can. So leaning into the data center conversation, the EIA looked at what they believed the US power growth would be over the next 5 years, 24 to 2030, 6 years. I guess 7, depending on where you set your brackets. The EIA's assumption was that the total US growth would be 600 terawatt hours over that time frame. And if you remember back 2 slides, we're about 4,000 terawatt hours, a little bit over 4 in the 2020s. So we've been growing a little bit. We expect to grow more. The reason I find that interesting is that is the EIA's look at what they think the entire US will grow. But that's a very different modeling approach. They assume a kind of a business as usual, no regulatory changes. And if you compare that with the individual ISOs or the independent system operators, these are the energy markets, the deregulated energy markets we talked about earlier. And you look at kind of each of their expected growth, just PJM and ERCOT being Texas and PJM being 13 states in the Mid-Atlantic, just those two alone are going to outpace the EIA's growths. The EIA does use a different method and a bottom-up sum looking at each of the individual operators. You would expect different results, but I point this out to say, from a grid operator's perspective, their requirement is to maintain reliability, and so for them, overestimating the growth is being conservative, right? They need to plan for the most growth possible so that they can maintain the reliability of the system. I think the answer is somewhere in the middle, but between the 580 and the 760 that we're looking at here. But it is important to point out that most of that growth is happening in the ERCOT and PJM regions. That's where a lot of the data centers are looking to come in. So quick notes about each of those. PJM, Virginia is a very popular data center place. They are working on policies to adapt to that. Their capacity market is really being stretched quite thin. Those who are, if you're on that in that region, your demand costs are now close to 30, 40, even 50% of your bill, depending on what your load profile looks like. So you're not paying for the energy as much as you are paying for the ability for the system to have the maximum demand. They are talking about having a new backstop capacity auction, which will kind of have data centers pay their own way, but we're already 3 or 4 years into, we've already committed to the next 3 or 4 years of energy buyers paying these pretty high demand charges. In ERCOT, they're looking at large loads as well. They benefited from, when I say data centers, AI is the thing that comes to mind, but it's also crypto as well as a few other like co-locations. So ERCOT benefited from data centers, specifically crypto, looking to come into their state maybe 4 years ago, a couple years before the AI boom. So they've had more time to plan for this growth, which is great for them, but they're still behind in terms of they're trying to get their first kind of aggregated large load analysis done this summer, so that they can get these loads added, and they're trying to get the generation on as fast as they can in both of these regions to kind of keep up with the growth. In ISO New England and New York, they are both neighbors. They're competitive markets. They're very concerned. If you look at the politicians and state governors and things like that, they will make mention of, we want to make sure that data centers don't destroy costs or the affordability of power. I think those are concerns. It's just not materializing. Again, look at the chart on the right to say that the growth in New England and New York is not nearly the same scale. Data centers want cheap land and cheap power, and neither of those regions have either of those. And so it's really more focused on those regions, looking at the infrastructure gains they've had. In New England, there was a transmission line connecting Canada to Maine, actually, to bring some hydropower down, which is softening prices in Maine. They're also looking to get some offshore wind coming online in a couple months here. There's been some, if you've been following the news, some federal resistance. August through January, quite a number of court decisions, judge decisions, made the projects off again, on again, off again, on again. They're on again. They're likely to be completed later this year. In New York, you also have a transmission line coming from Canada into New York City to alleviate some of the high prices in that region. They also have a gas pipeline and some more offshore wind coming in 2027. There is some grid growth in that region, a lot of electrification from buildings to try to reduce emissions is the large driver for New York City. If those infrastructure projects hit, we're likely going to be fine. If we see some delays in those infrastructure projects, you could start to see pretty expensive pricing just with the supply and demand balance being what it is. So that's the quick update kind of on different regional issues around the US. Again, if you have questions, feel free to enter them into the chat. I'd love to, or any of our team would love to talk to you about your specific region. I do want to take a quick moment to just remind you that the summer demand response time is coming. You likely have been aware of this and you know this, so we can go fast. But if you have the ability to load shed, either turning equipment down or generation on, if you can lower your load, you can be paid for it, and you can be paid handsomely depending on the region. You want to think about which programs you participate in PJM. The new capacity changes make demand response like 10x more lucrative than they were a year or two ago. You should also be targeting transmission costs in PJM and not just capacity. So make sure you're maximizing your programs. And also, if you are in sort of any sort of an asset planning stage, different regions are moving more to a seasonal model. MISO is already there. PJM just got there, and New England is going to get there soon. New York is getting there as well. So make sure you have the ability not just to operate in summer, but also winter. And if you do have an environmental control issue, sometimes the lucrative demand response can pay for any environmental controls on your generators. And then lastly, some of you may be curious what happened with Winter Storm Fern and why am I seeing such high invoices? Again, if you're in a deregulated region, most buyers are on some sort of, sorry, if you're in a deregulated region, you have the option of having a fixed price or a floating price. And usually people use a blend of the two. The fixed price creates the budget certainty. The open positions they vary, but usually on long time scales, they're cheaper on average. And so a blend of those two, fixed and open positions, is what most buyers use. If you're on a regulated utility product, you do have some exposure through the rate tariffs to wholesale markets, but it's usually just the wholesale the competitive offer the competitive options that see the most volatility from this. And if you had any sort of open positions, you're absolutely going to see higher invoices this winter, excuse me. So just kind of a quick, like, interesting, I think interesting comment that if you were to try to design a storm to move power markets, to move power and gas markets, it would have been hard to design a storm much better than this. So February 2026 is the gas contract time. So that contract trades 10 years out, 9 years out, 8 years out. And then eventually we get to the month right before, January. And then that contract will settle. And so that settles in gas bid week. You look at the last 5 business days, you chop off the back two. So those 3 days is when the gas contract will finally settle. Leading up to that, the 2 weeks before, prices don't trade on weekends, they don't trade on holidays. But leading up to that, if you looked at gas prices, you could have bought February gas anywhere between 310, 350, depending on the day. It trades within the day as well, but you could have bought February gas in this mid-3 range. The winter storm forecasts came out over a 3-day weekend, which gave the market one less day to respond. Prices started going up as we were concerned about Winter Storm Fern. Winter Storm Fern happened over the weekend. The power grid operators asked for waivers and received them to, any environmental controls, any restrictions on operating. They wanted to waive them for the week just to keep the generators operating. So now all that gas was going to powered plants as much as they could. And coming out of that weekend during bid week, the prices continued that upward trend and ended above $7. If we had the bid week, if the storm had been shifted a month back, you probably wouldn't have seen nearly the same impact on your supply bills. That's just what it is. So this is what you would have paid if you floated on the spot market, if you were on that sort of contract settle description that we talked about. There's a different kind of spot market, a different definition of spot market, where you float on a daily price. And if you floated on that, the two tend to track each other. But the important thing here is that the peaks, one of them happened in January. The daily settle spiked in January. And then the kind of monthly contract settle, that peaked in February. So depending on what your contract says, you would see a different high invoice in a different month. You're probably going to get paid with you're getting hit with a high invoice. It just the timing can matter based on the contract language. Similarly, you have power that had this day ahead versus a real time price. You can have a similar contract variance where the day ahead had this big spike. And I'm showing prices for Chicago here just because we noticed that one was operating a little bit differently. The real time didn't have the same peak, in part because the cold wasn't as bad in Chicago as expected, and so they had all these, rip out the stops, waive the environmental rules, and then when the day came, they were exporting power and prices stayed relatively low. We saw negative prices for a number of hours. So if you were on a real-time settle in Chicago, you didn't see a high invoice. If you were on a day ahead, you did. That's not to say real time is better than day ahead. In some cases, the reverse will happen. But just the way your contract is written will absolutely impact the cost you pay. And then I'll just end with this slide to say that, I think on the first slide we mentioned that there's this recent best practice was released at the end of 2025, and it really just focused on the three energy risks. We've talked a lot about commodity today with Iran, with data centers, the load growth, and the LNG exports. We talked a little bit about contract with the language and where your contract settles and how that matters. We didn't talk about compliance very much, but as incentives become available from the grid, or things like building performance standards set some sort of emissions per square foot target, those absolutely impact your procurement program and what you're trying to accomplish. So with that, I wanted to say thank you for joining. This is our first, hopefully, of many. We look forward to having these next month as well. And if you have any questions, I'm happy to address them now in the few minutes we have remaining.
Thank you for your timely insights, Ben. I know we all saw Storm Fern pop up and say hi on our energy bills. So now that we have some time, I would like to open the floor for any questions related to March's energy or energy dynamics in the first quarter of 2026. Please feel free to write them in the Q&A section, or you can raise your hand directly and we can spotlight you to ask your question. I will go ahead and ask a question that I had at a time where external factors, as you mentioned, with Iran and a number of global political events are causing significant LNG and oil volatility. How can energy buyers continue to be proactive and strategic in their decision making?
Hmm. Yeah, one of the interesting things about the recent events, Iran happens and U.S. markets are up 5%. 2026 gas was up for the first 2 weeks after. 2027 and 2028 gas really didn't move. And so I think one of the important things of any successful procurement program is having a longer buying horizon, and having that kind of foresight, or at least visibility into, 2, 3, 4, 5 years from now. Those who wait until the last minute, I mean, we saw this with Winter Storm Fern and that price, right? If you bought the beginning of January, you would have paid $3, and if you buy, the last day, you pay over $7. When you have, it's the same concept, but when you stretch that over years, if you're able to spend time monitoring markets, you can hedge when an opportunity presents itself and build up a layered program over time. And if you just wait until the last minute, you really are just stuck with what the market gives you. So I'd encourage you, even though it sounds like things are going a little bit crazy in the near term, there's still opportunities, 2027, 28, 29 to protect those budgets and to start layering in some protection there.
Great, thank you. Well, we have reached the end of our monthly briefing. Thank you, Ben, for sharing your expert insights with us today, and thank you to our attendees for your participation. We will continue to hold these briefings on the third Tuesday of every month, so spread the word and join us for our next briefing at the same time on April 21st for additional timely insights. This now concludes our webinar. Thank you.